Let us bring in our panel of experts. Joining me, Don Luskin, Chief Investment Officer at Trend Macro, and Michael Panzer, Wall Street trader and author of Financial Armageddon, Protecting Your Future from 4 Impending Catastrophes. All right, Michael Panzer, Armageddon, give me just a couple of quick bullets to start things off.
4 problems: debt, we've got government guarantees, we've got the retirement system, we've got derivatives, a confluence of dangerous forces all coming together right now.
All right, wait a second. Debt, derivatives, what were the others?
The retirement system and government guarantees.
All right, retirement meaning Social Security and what? Medicare, health care?
Yes, and put that together with the private system and the state system, put the whole package together.
All right, so it's sort of, Don Luskin, your response, it's sort of America going bankrupt problem as I hear it.
Larry, you know what? In 1999, a book came out called Dow 36,000. That was the time to sell. I love it that a book is out called Financial Armageddon. That's so fantastic. It makes me want to buy everything. But there's only one thing that worries me. Armageddon is a biblical term. It's from the book of Revelations. You'll notice today that gold traded at 666 per ounce and that oil traded at 66.6 per barrel.
Okay.
Number of the beast.
Mike Panzer, so Luskin's getting his juices up. He wants to buy because you're in the Armageddon selling camp. Let me just ask you some stuff here in the here and now. After a prolonged period of Fed tightening, the economy is slowing down. But for a couple of years, the Fed was very loose and highly liquid, and now it looks like inflation is sticky. So I'm calling that a rock and a hard place. What's your current near-term take, Mike?
Well, I don't think that inflation is the real big argument. Personally, I think that all the acts of the past 5 years the Fed has taken and the banking system on the back of that has created this tremendous debt problem, and ultimately that's more deflationary than inflationary.
And what does the debt problem do, in your judgment, to the movement of interest rates? And I want to ask you both the short-term federal funds rate controlled by Bernanke and company, as well as the 10-year longer run rate, which is a important valuation measure for the stock market.
Sure. 2 things. I think short-term rates will eventually come down when the Fed realizes the state of the U.S. economy and how bad things will turn out to be. But longer-term rates, I believe, could actually go higher. In other words, the yield curve widens as we get a bit of a credit crunch and we find a real problem on the terms of the banking system.
All right, so Don Luskin, what do you make of that? Short rates coming down, long rates going up?
Over my dead body. Short rates are not going down. Inflation is sticky. You said it yourself. Unless there is some kind of financial Armageddon that the Fed has to act to prevent, rates are going to stay right where they are as far as the eye can see. But when they finally move, it is going to be up because we got to get that sticky inflation unstuck, and that's the way it is.
Well, if I were Gary Schilling, or if I were Barry Ritholtz, or if I were Dougie Cass, frequent contributors to this program.
You're having a waking nightmare.
I'm not. Well, I've been off for 3 days, so I'm extremely fair-minded now. But if I were one of those chaps, they would say the debt Armageddon, if you will, is coming because of the subprime mortgage problem.
Well, I just simply don't agree. I've got 55 institutional clients who are the best and the brightest, and half of them are organizing right now to raise money for new funds. They're going to be vulture capitalist funds. They're going to buy all this subprime stuff at cents on the dollar. They're outbidding each other to take this stuff out of weak hands and put it into strong hands. There's so much money in the world, it's going to absorb this problem just like it's absorbed all the others the last few years.
How high can stocks go in here, Don? I take it you don't see any subprime contagion. So the other side of the coin, how high can stocks go, in your judgment?
I think stocks are going to go back to the highs of the year and can probably produce another 5 or 7% this year.
5 or 7%. Interesting. Michael Panzer, given your Armageddon scenario and your concerns about debt deflation and so forth, what is your current investment strategy?
Well, the first thing, I think Don just described a bell-ringing moment for the top of the market rather than a bullish sign, just as a kind of contrarian view there. But I think the outlook here is to be ultra-defensive. I think cash will be king. It hasn't been for quite a while. I think defensiveness will be the order of the day, and I think money will flow from towards less risky assets from more risky assets.
Mike, do you see corporate earnings going up in 2007?
No.
You think they're going to actually fall?
I think the trend rate will fall, and there's a possibility that the overall profits may fall as well.
All right, so Don Luskin, a bell-ringing top. That's how Panzer described your scenario.
Hey, turnabout is fair play. That's what I said about him publishing a book called Financial Armageddon. I didn't even have to publish a book, and I get the same thing thrown at me. That's efficiency.
Yeah, okay, but let's go back to earnings. He sees an outright decline or the possibility of a decline in earnings this year. Look, stocks are driven, I think you would agree, by earnings and the discount rate, which is most people use the 10-year bond rate. That does show some undervaluation in shares, does it not?
Well, it shows a huge undervaluation, something probably about 30%. Now, Mr. Panzer believes that the discount rate is coming down because the Fed's going to lower interest rates as its next move. So that's stock friendly. Earnings are another matter. Right now, the Wall Street cap-weighted S&P 500 consensus is calling for earnings growth of about 10 or 11%. It would take a gigantic turnaround, a historic disappointment to have even a flat year. It's not going to happen.
If I run the numbers on a 4% earnings growth basis, which I have done, if I run those numbers and I assume the 10-year bond rate stays right smack where it is, 465 or in that neighborhood, then yes, stocks are very undervalued relative to Treasury bonds, but relative to A-rated corporate bonds, they're only a little bit undervalued, 7%. And relative to Baa corporate bonds, they are actually completely fairly valued right now. You have a thought on that? What if that's 4% earnings?
Well, I'd like to jump in here. I think you're comparing it to bond yields that will in future be dramatically higher. I think the differential between the riskiest types of assets, the lower rated bonds, of which there's quite a bit of it outstanding, and the higher quality instruments will expand dramatically, and that may change the equation in terms of the calculus.
Well, I
agree with that.
That would be very negative for stocks, would it not, Mike?
I agree, yes.
Yeah, I mean, what are you talking about here? 6% 10-year Treasury, a 7%? How far does it go?
I think we'll see at least a 6% handle.
And what's your inflation on that outlook for rising long-term rates?
Well, I think that's the bugaboo. Everyone expects this to be strictly a deflation play. I look at it as more of a credit contraction play. I think we're seeing an unwinding of leveraging across the board, and I think that will play out in terms of lower asset prices, including bonds.
Don Luskin, if you look at the chart of the index of leading indicators, that thing is basically pointing to about 0, maybe at the most 1% economic growth. Why are you convinced that there won't be a recession this year?
Well, the index of leading indicators, isn't that, that's that thing that Louis Rukeyser used to have with his elves, right?
That's why I like to use it.
Yeah.
Lou is a friend and mentor of mine.
Well, Lou's a good guy, but that kind of technical analysis just has no credibility in my book. I don't even know how to answer the question because the premise just doesn't make sense. I simply don't give any respect to that indicator.
What's your investment strategy now?
My investment strategy right now is to treat this current dip in stocks as a correction, assuming we're going to new highs. Eventually, the housing adjustment, as the Fed calls it, is going to work through. The Fed is going to start raising rates. When they do, when they're about to, then it's going to be time to sell. That's not today. Today is the time to buy.
Is it Thursday or next Tuesday? When is the time to sell, in your view?
Oh, I think it's probably going to be a Thursday in September or October.
Mike Panzer, last word on this. What do you think of this guy, Luskin? Smart guy from the West Coast, but he's kind of hedging, Mike. Have you noticed that? He's like saying it's okay now, but it's going to get real bad.
Well, I think everyone wants to be the one that really rings the bell at the top. I think the bell's been rung. In fact, my ears hurt because it's ringing so loudly. So there you go.
Don Luskin, that bulge in your jacket, is it a small bell you're about to ring?
No, it just means I'm glad to see you.
You guys are great. Michael Panzer, thank you. Don Luskin, thank you ever so much.